All right, today we are tackling a huge topic, something that sounds pretty extreme, really, renouncing your U.S. citizenship. We're going to get into the nuts and bolts of the U.S. exit tax, what it is, how it works, and what it really costs to say goodbye.
I mean, let's just start with the big question right away. Why on earth would anyone willingly give up a U.S. passport? It's one of the most powerful travel documents on the planet. So what's going on here? What could possibly drive someone to make that choice? Well, for a growing number of Americans living abroad, it all comes down to one simple, or maybe not so simple thing: taxes. Yep, taxes. The U.S. tax system is, well, it's a special kind of complicated. And that's what's driving this drastic decision. To really get why someone would even consider this, we have to start with this really fundamental idea in the U.S. tax code. It's something that affects every single American who decides to live overseas. And this is the absolute heart of the problem. You see, pretty much every other country on Earth taxes you based on where you live. It's called residency-based taxation. But not the U.S. Nope. If you're a U.S. citizen, the IRS expects you to file a tax return and report your entire worldwide income, no matter where you live, no matter where you earned it. This creates this massive headache, this huge pile of paperwork, even if you end up owing $0 in tax. So for some people, that compliance burden just becomes too much, and they start to look at what feels like the only way out: renunciation. But let me tell you, this is not a simple path, and it comes with its own very serious costs. And we have to get this point crystal clear before we go any further. Once you do this, there is absolutely no going back. It's permanent. It is irreversible. For an adult, there's no cooling off period, no "I changed my mind." It is final. Okay, so you've weighed the options, you made the incredible decision to move forward. But here's the next big question: do you actually owe an exit tax? To figure that out, the IRS makes you run what I like to call the Covered Expatriate Gauntlet. It's a series of 3 tests. And listen up, because this is super important. The magic word here is any. You don't have to meet all 3. Just trip up on one of these tests and boom, you're what's known as a covered expatriate. And that status dramatically changes the financial consequences of walking away. So test number 1 is pretty straightforward. It's the net worth test. The IRS looks at absolutely everything you own all over the world: your house, your investments, your retirement funds, even your car. And if it all adds up to $2 million or more on the day you renounce, congratulations, you've passed test 1, which in this case means you fail the gauntlet. The second test isn't about how much you earn, it's about how much U.S. tax you've actually paid. They look at your average tax bill over the last 5 years. If that number is over a certain amount, it was around $190,000 for 2023, and it goes up with inflation, then you've met the second condition. Okay, and then there's the third test. And honestly, this is the big one. It's basically a simple yes or no question. Have you filed and paid all your required U.S. taxes for the last 5 years? If you can't check yes on your final tax form, Form 8854, and sign it under penalty of perjury, you automatically fail this test. Now here's the thing. This is by far the easiest test to fail. A lot of people, especially those accidental Americans who maybe didn't even know they were supposed to be filing U.S. taxes, fail this one. But it's also the only one you have complete control over. You can actually fix this by getting caught up on your taxes before you renounce. So let's talk money. What is the actual price tag for renouncing your U.S. citizenship? Well, the answer depends entirely on whether or not you're a covered expatriate. And this comparison just lays it all out perfectly. You see 2 totally different financial paths here. If you are not a covered expatriate, your costs are, well, they're manageable. There's a government fee and some tax prep fees. But if you are a covered expatriate, you're looking at those same fees
plus the dreaded exit tax, which could be anything from a few $1,000s to literally millions.
Let's start with the cost everyone pays. No matter who you are, what you're worth, you have to pay this administrative fee. It's $2,350. You pay it directly to the State Department, and there's just no way around it. So, if you're a covered expatriate, how does this exit tax actually work? Well, it's kind of wild. The IRS basically plays a game of make-believe. They pretend you sold everything you own, all over the world, the day before you renounced. This creates a pretend profit, right? A capital gain. Now, the good news is, they give you a break on the first chunk of that imaginary profit. For 2025, we're talking about roughly $890,000 you get to exclude. You only pay tax on what's left over. Okay, I know that's a lot of theory, so let's walk through an example. Let's talk about Maria. So her assets are worth $2 million today, but she only paid, say, $500,000 for them originally. So her unrealized gain, her paper profit, is $1.5 million. Now remember that exclusion. We subtract that, which leaves her with a taxable gain of $610,000. At the end of the day, her exit tax bill is going to be around $122,000. And get this, that's a tax on money she hasn't even seen yet. And you should know, this whole thing isn't just for citizens. Long-term residents, so we're talking green card holders who've had it for at least 8 of the last 15 years, they are subject to the exact same rules. And there is a critical trap here. If you're a long-term resident and you use a tax treaty to file your taxes as a resident of another country, the IRS considers that move itself to be an act of expatriation. It can trigger the exit tax right then and there, even if you haven't technically given back your green card. Okay, so you've done the math, you've analyzed the costs, and you're ready to move forward. What does the process actually look like? And what happens after you're no longer a US citizen? Well, the process is very structured. It's really 5 key steps. Step 1, and it's the most important, is you have to get fully tax compliant for the past 5 years. Only then can you move on to step 2, which is scheduling that appointment at a US embassy. At the appointment, you'll take an oath, and you'll pay that $2,350 fee. After that, you've got 2 last bits of paperwork. The big one, Form 8854, your expatriation statement, and then your final dual status tax return. And for those covered expatriates, cutting ties isn't so simple. The story doesn't just end when you walk out of the embassy. You might still get taxed on your US retirement accounts, like your 401k. But here's the real kicker, the one that affects your family. If you give a big gift, anything over about $18,000, to someone in the US, like your kid or grandkid, they, the recipient, get slapped with a massive 40% tax. It's a huge deal and can create problems for your family for years to come. So, before taking such a huge, irreversible step, it's worth just remembering the alternative. For a lot of people, the easier and cheaper path is to just get compliant. Because of things like the foreign earned income exclusion and foreign tax credits, the vast majority of US expats file their return every year and owe absolutely $0 in US tax. So that's what it all comes down to, right? The whole reason people even think about this is to find some simplicity, to escape this crazy tax mix. But when you look at the price tag, and the fact that you can never go back, you really have to ask yourself, is it worth it? Is that financial simplicity worth giving up your citizenship forever? And, there's no right answer to that. It's about as personal a decision as you can make.